Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back to the video recap that we do here each and every night. So what we do in this video is we go through all of the opening and or closing trades that we made here today. Now these alerts are sent out to just our members, and this video, while you may be watching this on YouTube, is actually posted just for our members and protected for 5 to 10 days inside of our membership area. So you can't get these alerts, you can't watch this video, it's all time sensitive information. You got to sign up for a free trial at our website at optionalpha.com. Now today's a little bit interesting. We don't have any new opening trades, and as we're getting close to the end of March expiration, which happens this week, this is the week that we usually start to roll off a lot of the losing trades. So generally speaking, the whole strategy is always, and if you go back through the video archives that we have either in the membership area or on YouTube, whatever the case is, then you'll start to see that we generally don't close any losing trades all the way through the month. We're literally holding on to these trades as long as we possibly can to give the market an opportunity to turn over or rally back up, whatever the case is. Home Depot being a great example of a trade that was a full loser, and then just this week has turned into a nice small profit that we did a video on last night. But now you start to see that we're actually taking off the trades that are not winners. So these are all losing trades that we took off today, and that's okay. This is what you're going to have as part of your portfolio. Generally speaking, the month of March has been very good, even though the market has gone higher. We've taken the bath on a couple trades individually, but generally speaking, the month has been pretty good. We're well positioned for April expiration, and definitely looking forward to moving forward and rebalancing the portfolio going forward. I think there's only a couple trades that we still have to close out the next couple days, and those are trades that are very, very close to being either in the money or out of the money, so we're just going to let them work another day or two and see what we get out of the market. Okay, I'm going to go over all these trades here very quickly because it's all basically the same type of idea with most of these, and the biggest question that I get a lot from people, especially members, when we get close to expiration is, why didn't you decide to roll some of these contracts? Now, there's only two reasons that you really want to roll a contract. One, you are getting a better price. So in the case of a credit spread, if you're going to roll a credit spread to next month, then you want to get an extra credit, right? You want to be compensated for your roll. You don't want to roll for a debit and pay money to go the next contract month. You might as well just close the position and reset your strikes. And the next reason that you roll is to extend the trade, so extend the timeline of the trade. And this is usually only the case if you have a trade that, like we said before, is very close to being either in the money or out of the money. So a trade that is a couple pennies away from the strikes that could make it a winner or a loser, it might be better just to roll that trade to next month. That way you're not running your trade up against the expiration period, and one little penny is going to make it a winner, or one little penny is going to make it a full loser. So you roll it to next month and give yourself a little bit more time, a little bit more room. But again, you just want to be careful about the pricing in your roll. You don't want to pay too much. You don't want to, obviously on credit spreads, you don't want to pay anything if you're going to roll. And you want to make sure that that new trade still fits the same criteria. So for example, on a lot of these trades I'm going to go through, you'll see that rolling just doesn't make sense because our original position was high volatility and now it's low volatility. It just doesn't make sense to roll and establish a new contract. So the first trade I want to go over is J&J. This is Johnson & Johnson, and we sold the 92.5, 95 call spread originally. Now today, we bought back that call spread for a 150 debit, and you'll see we took a $70 loss on this. And basically the whole idea with Johnson & Johnson is that this thing is already in the money, and as we get closer to expiration, this debit is actually going to swell to about 250. So we don't want to take that loss. It's about a $100 difference between where we closed out now and where we could potentially lose money in the next 2 days. So at this point, it's prudent just to close out the position, take the $70 loss, and move on. Now, Johnson & Johnson is a great example of a stock that had high implied volatility, but now you'll see that rolling this really just doesn't make sense. One, it's already in the money a fair bit. So we're up here at 92.5 to 95. It's already up at almost 94. So it's already well into the money. And to boot, implied volatility isn't above the 50th percentile. So we'd be establishing a credit spread that has low implied volatility. It just doesn't meet our criteria, and you can't roll it for a credit. So in this case, we just want to close out the position and move on. POT is one that we just entered just a couple weeks ago, and it was a vertical put spread that we bought. So we bought the 35-33 put spread, and today we sold it back to the market for a $42 credit. Again, same whole idea here with this one is that this credit could actually go to practically nothing. So we're saving some money here. Took a $64 loss on it per spread that we sold back to the market. So this one took a little bit more of a bite out of our portfolio, but that's okay, still keeping our risk size small. And you'll see in POT, same thing is basically held true, is that this thing is practically in the money too far for where, or not in the money enough for where we want to be. So it's obviously out of the money right now. Just want to get rid of the position. We can reestablish it later on if we want to, but at this point it doesn't make sense to roll. AXP is another interesting one. This is one that you could have considered rolling to next month possibly. Implied volatility was fairly high earlier in the week and last week, and you could roll it. We already established a new position in AXP, so at this point there's no need to roll this contract to the April contract. Or the April expiration contract. We already have a position in April, so better just to close out this one. We closed out the 92.5 call spread that we originally sold. We bought that today for a 145 debit and took a $68 loss per contract or per spread that we sold back to the market. Ford is another one that we closed out. This one was a call spread that we sold. It was the 15-16 call spread, and we took a $30 loss on this one, a fairly small loss for this type of position. It was a very small position in Ford. Implied volatility wasn't too dramatically high when we originally sold this original call spread, still above that 50th percentile. But at this point now, Ford is now in the money with this thing. It was kind of working and almost became a nice little winner here in the last couple of days, but just in the last 2 days, it's kind of really popped back up above 15. And you can see that it was really, really close to being a nice winner and kind of heading in the right direction, and just popped up in the last couple of days, which unfortunately is just bad luck and timing with the market. But we obviously have other positions that will take advantage of that move higher. FSLR is another one. I'll scroll down here so you guys can see. FSLR is another one that we had originally sold after earnings. So we had sold this almost the day after earnings for FSLR, and it had gapped lower. So our original plan with this was that we sold the 55.60 call spread, and today we had to buy that back for a $250 debit, so $141 loss. But this will turn into a $5 debit trade, so the loss could have swelled another $250. So at this point, we don't want to take that risk so close to expiration. This one is one that's very close on the dance floor, so it's very close to our strikes at 55.60. And I'll bring up FSLR here, and you'll see that our strikes are at 55 and 60, and with a break-even point around 56, this thing is very close to being on the dance floor. Now, originally, we had sold it this day here, right after earnings. So putting our strikes at 55 and our break-even at 56, we gave ourselves room after this earnings gap for FSLR to rally up. And it did that, and it came back down, and only for a couple days, and the pricing just didn't get any better. Now, implied volatility is fairly high, but it's not above that 50th percentile to be able to roll this to next month. It just does not meet the criteria. By rolling to next month, we would not take in a credit, and we'd be rolling into a low implied volatility environment, which isn't what we want to do. So at this point, if we're still bearish on FSLR, we close out this trade and we would look to reestablish maybe a debit put spread, something like that. That's exactly what you try to do in this position. Again, don't roll these things into a position that you wouldn't originally take right now. So if we wouldn't originally take a low implied volatility credit spread in FSLR right now, why would we roll it to the next contract month? Because that's basically what we're doing. We're getting rid of this contract month and establishing a new contract month and a new position. And then the last trade I wanted to go over tonight here with you guys is XOP. And that is one that we had that was a butterfly spread that we had bought. It was an even butterfly spread. So what we were looking to do in this one originally was take advantage of a drop in volatility, but also hoping that XOP would stay centered around our middle strike here at 66. So you'll notice that our strikes are about $3 wide. It was the 63, 66, 69 butterfly, which is different than a broken wing butterfly that we sometimes will trade here at Option Alpha. And we wanted XOP to stay centered around 66 and implied volatility to drop. Well, that didn't happen, and that's just luck of the draw. We had to sell it back today for a $10 credit, took a $54 loss on it. Very, very small loss on this thing. But you'll notice that XOP was just kind of all over the map from where we originally entered the trade. Our original trade was down here, centered around 66, which is kind of this grouping. This is where we wanted it to be. And you'll notice that XOP is well above our long strike out here at 69. So it really just doesn't meet that criteria. It doesn't fall within that window and just going to keep decaying in value. But since all of the options are in the money, it's best at this point to close out the trade by entering an order to close out for a credit. If we had done something that was a put spread with a butterfly instead of the call butterfly, then we would just leave these options on. They probably would have gone to expiration and you save the commission. But since we had a call butterfly, and these orders were entered in with call options, all of those call options are in the money. So they're at risk of being either exercised or assigned or whatever the case is. You want to get rid of these types of trades. If it was a put butterfly, then you can just leave it on because the market's higher and all of those options are out of the money and are going to expire worthless. So as always, hope you guys enjoy these video updates. This is a great example of what we do different here at OptionAlpha.com. And I stress this to a lot of people so many times because so many other services out there do not spend time on their losing trades. And we don't shy away from them. We're going to show you all of our trades, opening trades, closing trades, everything, profits, losses, whatever, so that you guys understand what really goes on behind the scenes. I think it's kind of weird that a lot of people in this business, they don't show you losing trades, but they kind of just say that they had losses or they understand that there's losses, but they don't really show you the trades. We're open here at OptionAlpha.com. I'm going to show you guys everything that we do. Every trade we make gets shown here on the nightly videos so that you guys understand what it really takes to trade options for income. You're going to have losing trades and you're going to have winning trades. And what makes the difference is the ratio of winners to losers and what you make on winners or losers consistently and making high probability trades. So as always, I hope you guys really enjoy these videos. Please add any comments or question below the video. I'll get back to all of those tonight or tomorrow before the open, and happy trading.